Hi, this is Alec Walker, EVP of Financial Planning in the Crestmont, Houston office, and you're listening to The Ascent with Crestmont Private Wealth.
The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
Welcome to The Ascent. This is Sam McGee with Crestmont Private Wealth. We have offices in Houston, Texas, and Boerne, Texas, out in the Hill Country, which did experience quite a bit of flooding the past 2 days. And by the time of this recording, it'll be maybe a distant memory, hopefully. We continue to pray for those first responders and those affected in the community for the recovery effort. So today we're going to talk a little bit about Fed policy. This is something that I think is a little bit misunderstood. And the reason I want to talk about Fed policy and interest rates is because there are so many misconceptions when it comes to what's going to happen with interest rates. Now, why would you care? Why would anyone listening to this care about interest rates? Well, they affect just about everything that you buy, that you borrow. Interest rates affect inflation. They moderate inflation. Also, that thing that you purchase that has a key to the front door, your home, maybe a car loan, maybe it's student loans, maybe it's for the wealthy family that's doing intergenerational transfer, where there's something called an AFR rate that relates to grantor retained annuity trusts. So it doesn't matter if you're talking about something basic or more advanced with estate planning. Interest rates affect your everyday life. So let's go ahead and start with, what is the Fed and what's it all about? How did it come about? How did interest rates start becoming something that was regulated? And let me give you a little bit of a history lesson on that. The Federal Reserve was formed December 23rd of 1913. Now, this is back when President Woodrow Wilson signed the Federal Reserve Act into law. And it was established to provide a safer, more flexible monetary and fiscal system. And this was after a bunch of financial panics. So I think it gets a little bit confused with what happened after the Great Depression, the stock market crash of 1929. And a lot of people think that it really started to occur then, but no, it was formed back in 1913, which was over a century ago. Now, the whole point of the Fed when it relates to interest rates is to monitor the economy and monitor inflation. Those are really the two kind of ends of the barbell, so to speak, just using kind of an analogy, thinking about two ends of a spectrum. You've got the economy, and then you have inflation on the other end. So let's just kind of think about what happens when the economy is really cooking, really just unabated progress, growth. Things are happening. Consumers are buying. Companies are doing well. Well, what's going to happen with that? What's going to happen typically is inflation is going to increase. Now, the reason for that is because people demand more wages. I mean, if you see your company out there just absolutely crushing it, you're probably going to be interested in a higher wage. You also see that as progress happens, people consume more, which pushes up the value of goods. And so there's a lot that goes into inflation, but generally speaking, when the economy is really, really cooking, inflation can start to kind of creep up. And it can also happen from printing too much money. And we saw that after the COVID experience, quite a bit of stimulus that occurred, and there was a lot of kind of free money out there from the PPM program and just lots going on there. And so what ended up happening was inflation really took off once rates were way too low and the economy was really recovering really sharply. So on one end, the Fed is trying to regulate that. They don't want high inflation. that is unstable for the economy. On the other end of the spectrum is the economy, and let's say that the business climate is gloomy, doom and gloom. Okay, so let's go back to 2008. Let's go back to the financial crisis. And right after the financial crisis, what happened? Well, there was a series of stimulus by the federal government, but also the Federal Reserve did drop rates. Now, why would they drop rates when the economy was stagnant? Well, let's think about that. Let's really break that down. If interest rates are really low, it's going to encourage buying, borrowing. It's going to encourage investment. So by lowering rates in a bad economic climate, what that's going to do, it's going to give an incentive for businesses to reinvest in new products, in growth, in new buildings, in real estate. And so think about it as sort of a modulator, almost like a thermostat in your house. You know, you get too hot, ideally if everything works, you crank it down, you feel better. The Fed is almost like that thermostat. They want to be able to control the economic growth as well as start to put a lid on it. So let's say that the economy is doing really, really, really well and inflation's picking up. They're going to do exactly the opposite. They're going to raise rates. The reason they're going to raise rates is actually to discourage more investment, discourage more consumption. And what that does is that stops kind of frivolous spending, but also frivolous investment, and it ends up bringing inflation down. It also cools down the economy. So it's really interesting. I started out in weather back at Texas A&M. I was in meteorology and really wanted to be a meteorologist. And one of the reasons why I wanted to do that is because I loved how dynamic it was. Also loved public safety and whatnot. But really, I made the switch to finance because it involved a much more complex, in my opinion, set of variables. And it involved business, which I love. And I also like serving families. And that's what we do at Crestmont Private Wealth. We serve wealthy families. But what we're talking about today is the Fed and interest rates. And what is it all about? Because I think it is a very misunderstood principle of what interest rates do, why they're regulated, what does it mean when they go up and go down. So if you're listening to this and you already know it, great. You can tell a neighbor, tell a friend. But if you don't know how the Fed operates and some of the misconceptions of interest rates, I hope you learned something today. I certainly enjoy this, and I love teaching financial literacy. So let's talk a little bit about the Fed and lowering rates and raising rates and how that relates to probably something that you care about a lot, which is mortgage rates. So many of you listening to this, especially if you're in your, call it, 40s through 60, somewhere in there, prime home ownership age these days. Unfortunately, it's gotten a lot older. It used to be you bought a house in your 20s. Now a lot of people buy them in their 40s because they're a lot more expensive. Well, if you're listening to this and you think, well, this is great. If the Fed lowers rates a few what we call basis points, and usually it's in quarter percentages, so 25 basis points is a quarter point, a quarter of an interest rate. So 0.25% is 25 basis points. So you learned something interesting about finance terms today, basis points. If they were to lower the short-term interest rate 25 basis points or a quarter percentage, do you think that interest rates for mortgages are automatically going to drop? That's kind of a trick question. The answer is depends. So it's really interesting that mortgage rates are not perfectly correlated with what the Fed does. The rate to look at actually that correlates really well, meaning moves in tandem with more closely, is going to be the 10-year Treasury. And let me explain why the 10-year Treasury is more of a barometer for mortgage rates. And you should care if you have a mortgage, or if maybe your kids are buying a home, or your grandkids. So the 10-year Treasury is going to be a little more close to what mortgage rates are doing, because it's a indication of what's happening over a longer period, a 10-year period, a 10-year rate, more of an indication of inflation plus economic expectations, not short-term rates, not short-term borrowing rates. So if you're interested in kind of tracking what's going on with mortgage rates, usually there's lots of apps that you can pull up and look at mortgage rates every single day. But if you kind of want just that non-biased barometer, the 10-year Treasury. So hope you learned something today about that. And I do think you should watch it if you are a mortgage holder, if you're a borrower, or if you have kids or grandkids that intend to buy homes, because it has a big impact on the affordability of homes. So technically speaking, when I talk about the Fed, it's the Federal Open Market Committee, the FOMC, which sets the monetary policy by adjusting the target rate for the federal funds rate. So that rate that we talked about earlier is that short-term rate. So if you kind of think about just the most basic function of the FOMC, it is going to be to set that target rate, which is really the interbank lending rate. And I'm not going to get into that today because I'll probably lose you, but it has a critical purpose, an absolutely critical purpose. And the way I like to think about it is kind of like where we started in the show, the flood. When floods happen, what do you want to have happen? You want to have your fire department, swift water team, EMS, state resources, the National Guard, the game wardens. You want everyone assembled and ready to respond. You don't want to be unprepared when those things happen. So think about that flood like an economic collapse. Let's say that we have a big, sharp, sudden economic collapse that has happened in the past. 2008, we had a very short-lived COVID experience. We had the 1929 crash. You could go back to 1987. So think about the Fed as being all those resources kind of jammed together with the federal government. Now, do I think that that is a long-term sustainable thing to constantly be throwing stimulus into the economy? Well, that remains to be seen. I mean, we will see with time. But what I do know is that regulation of interest rates when there is that financial crisis is a very good thing. We've seen it help stimulate economies that are absolutely stagnant, and we've seen it help those economies that are overshooting with inflation by raising rates to get them in control. And we've seen that since COVID, which has really been sort of a soft landing. The only downside, I really think, to what happened with COVID economically is everything costs a lot more now, which is pretty rough. So economic progress over time will start to erode that away, and that's what I hope does happen. Prosperity is something that I think is really important in a capitalistic society, and what we've been talking about today is interest rates, the Fed, how it operates, really at the basic level, because I want our listeners to understand a little bit more about financial literacy. At Crestmont Private Wealth, we serve wealthy families, those typically with $1 million and up in liquidity, that desire to have a partnership with their wealth advisor through all their life circumstances, financial planning, investment management, and multi-generational planning with their kids and their grandkids. We absolutely love to serve, and if you've been listening to us for a while and you'd like to reach out, please do. info@crestmontpw.com, and my direct email is sam@crestmontpw.com. We hope to hear from you. Have a wonderful weekend, and God bless.